Hi everyone, welcome to another episode of the Patient Wallet channel. In today's episode, we have the Fed Chair, Jerome Powell, saying that stocks are fairly highly valued. Intel stock is rising from the dead. We're going to look at Nvidia's $100 billion investment in OpenAI and answer a couple of subscriber questions. If you are new here, I share my personal finance and investment journey with full transparency on this channel. I'll share the good, the bad, and the ugly, so subscribe to the channel to follow along and like this video to help us reach as many people as possible. Remember, before you take any financial decisions, please do your own research. Right, let's jump straight into the video with a portfolio update. The portfolio value is sitting just over £10,000 with a return of £906 or 9.78%. Google and Adobe are the two stocks in green, with the majority of gains coming from Google, and Amazon, S&P Global, and Fair Isaac are in the red. Allocation-wise, we have 38% in Google, 26% in Amazon, 14% in S&P Global, 11% in FICO, and the remaining in Adobe. Looking at portfolio stats, the 3-year revenue CAGR is 11.5%, 3-year diluted EPS CAGR is 33%, gross profit margin 64%, operating profit and net profit 30 and 25% respectively. Return on investment capital is 24%, return on equity 20%, the trailing PE 34%, the net debt balance is a negative $1 billion and the free cash flow yield sits at 2.4%. Overall, I'm feeling very comfortable with this portfolio over the medium to long term. Looking at individual holdings and starting with my two largest positions, Google and Amazon. On this chart, we have the forward PE. We have Google in purple, Meta in green, Apple in blue, Microsoft in orange, and Amazon in red. In my opinion, there is no reason why Google trades at a lower forward PE relative to other big tech. We have Search, which is a free cash flow machine. Google's DeepMind has the talent, compute, data, and recently showcased that they can execute on their product roadmap. Google Cloud will continue to expand revenue, margins, and has a competitive advantage because of TPUs and the pivot to inference. They have great distribution channels and data sources from YouTube, Maps, Gmail, Chrome, and Android. And lastly have Waymo, which is the long-term bet and the leader in robotaxi. We can see that the forward P increased over the recent months but remains below big tech. On the other end of the spectrum, we have Amazon with a forward P of 33 times. The story here is a bit different as Amazon continues to showcase their ability to lean in when they see growth opportunities. This chart here shows CapEx spend over the last 5 years for the big tech. We have Amazon in red, Apple in blue, Microsoft in orange, Google is in purple, and Meta in green. As we can see from the chart, every single year, Amazon has invested more than the rest of the big tech, and in 2025 invested $108 billion, which is almost the amount that Microsoft and Meta invested combined. I expect these investments to benefit shareholders down the line. We also had Amazon reaching a $2.5 billion settlement with the FTC over deceptive Prime program. On Thursday, it was announced that Amazon will pay $2.5 billion to settle the FTC allegations that it duped users into paying for Prime membership. Amazon will pay $1 billion civil penalty to the FTC and will refund $1.5 billion to an estimated 35 million customers. This lawsuit was filed back in 2023 under the Biden administration and claimed that Amazon deceived tens of millions of customers into signing up for its Prime subscription program and sabotaged their attempts to cancel it. My view is that good products should not engage in any deceptive strategies or making it hard to cancel memberships. I think Prime is one of the best value propositions out in the market today, and Amazon should make sure that people can sign up clearly but also cancel when they don't see the value in it. This is an expensive mistake that Amazon has to pay, and for the stock, this is neutral. I'll skip S&P Global as I did a video last week, so go and check that out. Next one is FICO, and my thesis is pretty simple. Once the 30-year fixed rate mortgage comes down, FICO stands to make a lot of money. Looking at this chart, we can see that the 30-year fixed rate mortgage in the United States peaked at 7% and is now lower and stands at around 6.3%, but remains elevated when we look at the last 5 years. I believe if we return to levels we've seen back in 2022 or at around 4%, the housing market will be revived and FICO stands to benefit. And the last stock is Adobe. The market narrative is that AI is killing their business. In my opinion, this is the wrong narrative, and over time, this narrative should be corrected and the market should re-rate. On this chart, I show the free cash flow per share in blue and the stock price in red. we can see from the chart that the stock price is tracking free cash flow with some overvaluation around 2020. However, in the last year, free cash flow went from $14 to $22, where the price went from $570 to $360. So this disconnection doesn't feel normal to me, and I think it should correct over time as management showcases that they can execute, layer AI, retain customers, and increase free cash flow and earnings for the business. Okay, let's move at the comments made by the Fed. Fed's Powell says stocks are fairly highly valued. During an appearance in Rhode Island on Tuesday, Federal Reserve Chair Jerome Powell appeared to cause a stir in the equity market when he said that stocks were fairly highly valued. Powell's comments, coupled with creeping doubts about the durability of the artificial intelligence trade, were widely blamed for a bout of market weakness. By the time the closing bell rang, Nasdaq had fallen by 1%, tallying its biggest daily drop since 29th of August, according to the Dow Jones market data. Regardless of where they believe stocks might be headed, many stock market strategists at least acknowledge that Powell has a point. The relentless rally for the S&P 500 and Nasdaq over the past 3 years has carried several widely used valuation metrics to record or near record levels. Powell isn't the first Fed chair to call out the exceedingly high valuations in the equity market. During a speech in December 1996, Greenspan said, "But how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions?" Greenspan has been widely credited with popularizing the phrase irrational exuberance, which came to define the dot-com bubble. So let's look at some indicators. The CAPE ratio takes the level of the S&P 500 and divides it by the average inflation-adjusted earnings of its constituent companies over the past decade. We can see that it has been rising over recent years, sits at close to all-time highs, but remains below the dot-com bubble. Looking at the Buffett indicator, which is the aggregate value of the US equity market divided by the total output of the US economy, and again it has been rising, it sits at all-time high, with the US stock market now worth 2.7 times GDP. The price to sales ratio sits at all-time highs and higher than the dot-com bubble period. Lastly, looking at the PE ratio, it sits at 29 times, above average historically, but sits below the dot-com bubble. If we look at the timing of the Greenspan comment before the dot-com bubble, the market has increased by around 100% since those comments. My thoughts on this are the following. We live in a new normal. We have different constituents of the S&P 500 relative to the 2000s. We have high quality, profitable and growing companies in the S&P 500 today. However, bear markets are inevitable and are going to happen at some point in time. So investors should be ready to capitalize on the volatility that we will see in the market at some point in time. I'm certainly not planning to divest my portfolio. I'm continuing to invest in high quality compounders and focus on the longer term. I'll show you the good and the bad in this channel, so subscribe to the channel and follow along in this journey. Okay, let's look at how the market performed last week. We have mixed bag here. Big tech being mostly down with the exception of Apple, which is up 4%, and semiconductors being flat with the exception of Intel. Well done to all recent Intel investors, and let's look at why Intel is up big time this year. Intel is up 77.5% year to date, 51% on the last year, but remains down over the last 5 years. Why did Intel rise this year? Intel is up because of major investments and strategic partnerships. The US government invested $8.9 billion into Intel in August, a move to support domestic chip manufacturing. Nvidia made a $5 billion investment in Intel, signaling a collaboration on developing chips for PCs and data centers. The Asian tech conglomerate SoftBank invested $2 billion into Intel. Intel is reportedly seeking an investment from Apple, which could provide a significant boost to the stock, and a strategic collaboration with Amazon Web Services was also announced to support the chip industry. Despite a period of a decline due to product issues, Intel is seeing renewed interest and a positive outlook from analysts and investors. The combination of government support, major tech investments, and a potential turnaround strategy has led to significant rally for Intel's stock. I think this is a pretty good summary. We'll see where Intel stock goes from here. And well done to recent Intel investors, as 77% year-to-date return is pretty remarkable. Okay, let's move to Nvidia's $100 billion OpenAI investment. Nvidia said it will invest $100 billion into OpenAI in a deal that highlights just how big the chipmaker's investment portfolio has become since the arrival of generative AI in 2022. The deal came just 1 week after Nvidia committed a $5 billion investment into one-time rival Intel, and after the company announced the intention to make $500 million investment into self-driving car startup Wave and a $500 million investment into a UK cloud provider Nscale. If the full OpenAI investment is completed, it is expected to be carried out over an unspecified number of years. It will represent Nvidia's largest investment ever. The majority of Nvidia's portfolio companies have some strategic connection to the company's business, either developing complementary technology to its chips, selling rented access to its chips, or using the chips for AI, enterprise software, or robotics. Looking at their most recent 13F filing, Nvidia has investments in Applied Digital Corporation, Aram Holdings, CoreWeave, Nebius Group, Recursion Pharmaceuticals, and WeRide. Nvidia's massive investment in OpenAI announced last week will put billions of dollars into the coffers of the artificial intelligence startup to use as it sees fit. But most of the money will go towards use of Nvidia's cutting-edge chips. The agreement between the two companies was big on numbers, but thin on specifics. They said the investment will reach up to $100 billion paid out as AI supercomputer facilities open in the coming years, with the first one coming online in the second half of 2026. The timing of the build-outs and the cost of each data center remains up in the air. However, what's become clear is that OpenAI plans to pay for Nvidia's GPUs through lease arrangements. Nvidia's CEO described this deal as a monumental in size, has estimated that an AI data center with a gigawatt of capacity costs roughly $50 billion, with $35 billion of that used to pay Nvidia's GPUs. By leasing the processors, OpenAI can spread its costs out over the useful life of the GPUs, which could be up to 5 years, leaving Nvidia to bear more of the risk. I think this is expected from Nvidia. They have seen their free cash flow explode over recent years. 10 years ago, Nvidia's free cash flow was $1 billion, and today, the last 12 months free cash flow sits at $72 billion. Nvidia has benefited from the AI revolution. In fact, it's leading the AI infrastructure revolution. So I do expect their investments to grow over time as well, as they need to find places to park or invest their money. They also have a grade A balance sheet with a net cash position of $47 billion. Nvidia has the capacity and liquidity to make these investments. So let's see how this pans out over the medium to long term for Nvidia. To me, this deal also highlights that it's important for AI players to be profitable. OpenAI is burning cash, is not profitable but is growing fast, and is dependent on external financing. External financing is not a problem when we are in the good times, but what happens if we enter a bear market or liquidity in the market dries up? I think this will be a major problem for OpenAI, which will only solidify Google's dominance in the AI race. So let's see what happens. Okay, let's move on to a couple of subscriber questions. I received the following question from No Ordinary Experience 7815. How and when will it become clear if Vantage 4.0 dents FICO? How will this become clear? This is the ultimate question for my Fair Isaac thesis, and that's why I keep my position relatively small at around 11% of my total portfolio. We are going to find out how Vantage 4.0 impacts FICO's business over the upcoming earnings calls, and the best indicator will be fundamentals, how fundamentals evolve over time, and what commentary we receive from FICO's management and its competitors to understand how market share is impacted because of this new adjustment from FHFA. What we know so far is that the FHFA announcement they made back in July is that FICO's 10T score is expected to be implemented at some point in time. I think FICO has some time before we see its business being disrupted because FICO is very well embedded into this industry. However, as time passes, the risk of its fundamentals being disrupted increase as well, as they need FICO 10T to be also approved for usage from FHFA. In their announcement, they stated, Vantage Score 4.0's implementation process has arrived at a point where the enterprises soon can move forward with adoption of scores from the model. Similar implementation efforts are underway with respect to FICO 10T, and the enterprises expect to be able to publish historical FICO 10T data and adopt scores from the model at a later date. The key question here is, when is this later date? In the meantime, I will continue to monitor the fundamentals and the earnings call from FICO and its competitors. We had another comment from SSOTUC user to look at Zoetis and Merck. Let's look at one of these two companies, and that will be Zoetis. I don't know anything about these companies, so what I'll do is I'll just go through a quick check to see if this company can enter my early screen shortlist, and then I'll subsequently go and do additional research when I get the time. So, Zoetis Inc. discovers, develops, manufactures, and commercializes animal health medicines, vaccines, and diagnostic products in the United States and internationally. It commercializes products primarily across species, including livestock such as cattle, swine, poultry, fish, and sheep, and companion animals comprising dogs, cats, and horses. So this company is essentially a pharmaceutical company for animals. The market cap is sitting at 62.5 billion. The trailing PE sits at 24.7, the forward PE at 21.9. The 3-year revenue CAGR is 5.5%. The 3-year diluted EPS CAGR is 9.7%. The company pays a small dividend with a dividend yield of 1.3%. Has gross profit margins of 72%, operating and net profit margins of 38% and 28% respectively. Has a return on equity of 48%, return on capital employed of 26%, and return on invested capital of 24.3%. Revenues are steadily growing over time, which is a good thing to see. Operating profit is also growing steadily over time, and we can also see that operating profit margins are also rising. Diluted EPS are going up and to the right, and the company is doing share buybacks. So far, so good. The company has a net debt balance, as you can see on this chart here. The free cash flow excluding stock-based compensation and free cash flow is also growing over time and sits at around $2.2 billion, which is roughly half of the net debt that the company has on its balance sheet. And lastly, valuation-wise, we can see that the company trades at a forward free cash flow yield of 4.2%, and its valuation has been dropping as of lately. Looking at what the bulls say, growing interest in probiotics, antibacterial peptides, and immune modulators as alternatives to antibiotics offer many targets for innovation. Companion animals are increasingly viewed as family members. Because the animal health industry lacks large players, Zoetis maintains significant pricing power, and the bears say strict regulation or restriction of antibiotics use in animals could harm Zoetis production animal product sales. Lower margin emerging market sales will make up increasing portion of company sales, potentially creating a headwind to Zoetis margins. And lastly, emerging market customers may be more price sensitive and more open to using generic products. So yeah, overall I think Zoetis looks interesting. I will add it on my early screen watch list. I'll do some additional research and I'll leave it here. Let me know if you enjoyed this episode, subscribe to the channel, and I'll see you in the next one.